So, folks, if you're just joining the webinar, I again want to just make sure everybody is clear. We are going to get started in just a moment or two. Very excited for today's discussion. I just want to remind everybody the Q&A is going to be done through the Q&A function on the Zoom webinar. We also have the ability to you can send me an email. I mentioned email address before, or send in a text message because I don't want to take any time away from having Jeffrey Sherman take the floor in just a moment. So let me just give you a few of the statistics on the Advisor Network, and then we're going to get started with our keynote discussion. So I'm not going to show the slides on the screen. Instead, what I'd like to say to everybody is thank you for being part of the 7,000 wealth management professionals, part of our overall community in just the last 19 months. We're thrilled that you've been able to obviously either watch this live, or a lot of you are going to be watching this on recording. One of the cool parts today is we get to talk to Jeff just before the Federal Reserve even has their discussion here in just a little while. And so as you're watching this later on, you're going to get to hear some live action content. But the 250 of you that are part of our on collaborative portal, that's fantastic. We're all about the sharing of ideas between advisors. So excited to get started today. I'd like to welcome Deputy CIO Jeffrey Sherman on with us today. And Jeff, it's great to talk to you again.
Yeah, it's great to see you as well. And thanks everyone for tuning in, those live and those that are watching it later on in life.
Yeah, later on in life, hopefully within a couple of days, and let's see if we have any shell shock after today. We've been able to chat a number of times on stage, on the computer, and otherwise. Never an hour before the Fed decision, so that's kind of an interesting timeline for all this. What are you seeing, feeling, hearing? What's the pulse of the world right now, in your opinion?
Yeah, thanks, Colin. And as I look through it all, I mean, this is the most challenging kind of Fed meeting we've had in a long time. And it's challenging from a standpoint that at the last meeting, Kevin Warsh said that he didn't want to talk to us anymore. He didn't want to give us any insights. He didn't want to make any forecast. He refuses to forecast, and that they're going to essentially not give us as much information. And so that's caused a little bit of consternation in the bond market at this point. One, I think it's helpful that he had the messaging from the previous press conference where he said that they are going to tackle inflation, and he said we will get inflation down. We will get inflation down. They asked him, "What'd you have for breakfast?" He said, "We're going to get inflation down." I mean, it was the answer to everything, and so I think that helped the bond market in some way, saying, you know what, they're going to get inflation down. But then he kind of pulled the rug out from us of saying, well, we're going to change the data set we're going to look at. We're going to assign task force. We're going to talk about our communication policy. And, to me, it was that our communication policy is going to be less communication. And so when we go into the Fed meeting today, the bond market has a little bit of a probability of a hike. You can call it roughly 30%. I think you have to get used to seeing that because if we don't have a lot of forward guidance, you're going to have to rely on data, and we have to rely on, kind of the what we call the bloodless verdict of the market, right? And so, should Kevin Warsh hike today? Probably. And it's not because of the war. It's not because of oil prices. I mean, there's just some pent-up inflationary pressures inside the system. So I think if you didn't have a change in leadership at the Fed, I think if you had Jay Powell still sitting in there, he would say that, we probably regret those last couple of rate cuts we gave, and we probably need to reverse them. I think that's where the bond market is today. The challenge is they don't hike today, which I don't think they do, by the way. So our sense here at DoubleLine is it's not really a hike. If they do hike, you may cause some pain in kind of equity land today. I think that's one other reason that they'll have a problem because you had some weakness in tech and you've had some weakness in software and the AI related names. The market in general seems to be focusing on now the CapEx spend and the lack of free cash flow at like Alphabet last week, right? That was a huge kind of test for the system and to see what's going to happen again as some more megas report or the hyperscalers at least. So I bring all that back together because that if the Fed doesn't hike today, which we don't think they do, it's going to be extremely difficult for them to hike in September. And the reason being is that Fed meeting is about 5 weeks prior to the midterms. So again, from a political standpoint, we already see the pressure the president's putting out there. He's saying Kevin Warsh knows what he wants to do, he knows what he should do, but maybe the committee won't let him. And I think that's an important takeaway here because the president admitted it is a committee. He admitted that there's multiple people making this decision. So I think we're going from a world where it's been this stewardship and leadership at the Fed for really since the Greenspan era, I'll say, where there was this chairperson making a decision and coalescing around it. Versus now, I think Powell set it free to give more freedom to the governors last year. And by doing so and publishing these dot plots to the cycle, it's created more of this. So where I'm going with all this is that yes, the Fed meeting is important, but the reason that the Fed doesn't have to hike is the bond market has done the hiking for the Fed.
Yep.
And what I mean by that, yes, they didn't bring SOFR up or T-bill rates and the cash rates, but the upward sloping term structure we've seen in the Treasury market since March is something different that we haven't seen in this rate cycle. And so I think it's very important to look at because this is the way the fixed income market used to trade earlier in my career. And I know I look like I'm 70 or so, but I did start in 2000. And so from that standpoint, this is the way the market typically trades. The aberration was kind of what I'd say the GFC to the pre-pandemic era. So coming back to all this, what are the implications here? I think the implications are ultimately we're going to have a little more choppy market in rates, which is going to, kind of have spillover effects at times. But really, the rates market's been somewhat contained. Yes, it feels like it's very painful because the two-year Treasury was at its cycle lows, as we entered the war in Iran, and it's completely repriced and it's been 60 or 70 higher. But when you look at these trading ranges, we're just at the upper end of ranges. And so, to me, where the rates market causes a hiccup to more risk assets. And again, I'm not worried about software and tech selling off in the last, 6 weeks or 8 weeks, whatever it's been, because remember, they went up 50, 60% in the two preceding months, right? But the challenges, I think, for risk assets are if we test new highs in the 10-year or the long bond. And so what I'm looking at for kind of critical inflection points is that can the 10-year get over 5%, which I think it's going to be challenged to do so. But if it does, there's going to be a new regime at that point. And so I think that's kind of what the bond market's dealing with is that do we have actually real growth coupled with this inflation? Is it kind of the real yields are reflecting some impact of inflation? Or is it that also, at the end of the day, remember the BEA is going to change, the Bureau of Economic Analysis is going to change some of the methodologies of the inputs that go into CPI, which also like, great. Well, there you go. You help Kevin Warsh. That's going to shave 20 or 30 basis points off CPI itself. So putting it all back together, and it may sound like it's a convoluted answer to your question, but putting it all back together is that I think the Fed can be on pause through the midterms. But the problem is that if these pressures persist over that period, the next hike will be 50 or higher, and it'll have to be. And at some point, they're going to have to cool it. So the bond market's somewhat there. I would argue if you look at the two-year Treasury, you kind of look at the curve. But also, from that standpoint, 10-year rates, mortgage rates higher, it's having its own tightening kind of impact on the market right now.
So I want to come back. You said something interesting in terms of it's not the war. So I want to come back to that in a second, but I want to touch one more Fed thing and we can move off that. We talked about the committees, right? The fact all these committees that have been formed. And I guess the question is, in your opinion and a long
Yeah.
time of looking at this, what do you think the output is going to be? And is it helpful? And this whole idea of this, is this like a new Fed that's essentially being born?
It is a new Fed, but that's what happens whenever you have leadership change anywhere. We talk about new administrations when it comes to politics. We're talking about midterms, the new regime coming in. And so you have it at organizations. When new people come in, change gets implemented.
Yeah.
So it's not a bad thing. But by the way, the Fed does postmortems on themselves, and they do change policies even with the same Fed chairperson. The committee approach, I think it's best summed up. I think it was Waller that said this. And I may have the wrong person, but I think it was Waller. And when what the quote was that, or I'll paraphrase because I won't get the quote exact, but it's a, well, if you tell me who's on the committee, I'll tell you what the output is of the committee, right? And so that's where I kind of think about this committee. When I look at some of the people chosen, it's like, why are we choosing former central bank heads to give us opinion on that? I mean, for communication policy, like Mervyn, it's just some of them are strange. But what I see there is a lot of tech people. I see a lot of tech people, a lot of AI proponents. And so I wonder what that influence will be. And so I think it's important because the committee membership matters if we're going to rely on those opinions. So if it's we're coming at a data collection and talking about maybe a different metric of inflation, sure. Once the market knows what that number is, we're all going to obsess over it, to 7 decimal points of precision, even though he says it only looks left of the decimal. So when I think about ultimately, what the committees do, we're just going to have to wait and see. But it seems to me that he stacked them in a way that it looks like he wants to be AI friendly. He wants to be tech friendly. And if you remember, Kevin Warsh has been on the record many times talking about the disinflation or deflationary pressures of AI. I disagree with that in the short term, because you can't tell me that the last $500 billion we've spent on CapEx expansion in the last 9 months is not inflationary. You're spending money, you're creating demand for the inputs into this process. And by the way, what do we need? We need data centers, we need copper, we need brick and mortar, we need cement, we need semiconductors, we need chips, we need memory, we need storage. I mean, and we're all competing for the same asset. That has to be inflationary. That you're creating this kind of demand shock out there where there's a supply shortage relative to it. So ultimately, we'll have to see if it pans out. But the market at some point, if it doesn't believe what Kevin Warsh is doing, it will trade what it thinks is going on. And right now, I think the market's giving Kevin Warsh the credit as it should, but we'll have to see how that evolution takes place.
You just mentioned about 13 things that can contribute to inflation. The one that we're watching the headlines, clearly gasoline, clearly related very closely to the war, not war, war again. We
Yeah,
don't call it a war.
yeah.
What, I mean, this is dragging out longer than anyone would have thought. Clearly, this is definitely an inflationary headwind.
Mm.
What's your thought of where this goes?
Well, I mean, you can't rename the Department of Defense the Department of War and not call it war. That's what I'm going to start with. So let's just call it what it is. When you're lobbing rockets and missiles and drones, it's war. You tell anyone in the area that it's just a conflict. No, it's war. And so, yeah, there's going to be pressures. But what this does is, in the middle of all this kind of supply chain issue, now you're disrupting the energy side. And so the disruption is that people never thought of Iran as controlling the strait. Iran controls the strait. I don't care what our fellow Americans say right now. They obviously are controlling the strait, or there wouldn't be anything else going on right now. The challenge I've had with the oil market is that the focus has been, once the conflict is resolved, that oil will flow out of the strait. And I'm always pulling my hands down because that's the
Mhm.
direction it goes. My question is, which ship captain wants to go back into the strait, right? Once you get out, what does that look like going in? By the way, ships need insurance, right? Freight insurance, freight costs just went up, and they're not going to dissipate in the near term. So all of these things have some of these impulses there. Now, the thing about oil prices, we saw, oil went to 115 in the US, 120 in the global markets, and fell back down. So that's how we saw CPI kind of soften a little bit. There were some other positive attributes in the June CPI report. But the thing about it is that when you think about that volatility of the energy, that's fine. But it'll go away for the inflation side. But remember, we entered this year, oil was $55. Oil was not 80. We act like it's 80. Oh, we're back to good times. That's a new shock to the overall system. It's a new level. And so that's the thing we're going to have to digest. You mentioned as gasoline. I always find it interesting when you talk to, your fellow Americans. If you ask them about inflation, they're going to usually quote one of two things: how much they're paying for gasoline or what food cost, right? And it's funny, the Fed strips those out of the calculations because they're more volatile. But there's pressure everywhere. And energy is such an input to everything. And by the way, we're talking about building data centers. What feeds a data center? Energy, right? So all these things are there. But by the way, we're seeing inflation in the service side. Yes, the owner's equivalent rents come down a little bit. We'll see if that's, from some of the data collection issues last year. But ultimately, you're seeing that core services ex shelter, which is actually what we all consume, continue to have inflationary pressure. So it's just a conundrum there. And I think that's the challenge. But let's rewind it. We're talking about inflation. We're talking about how it's a problem. It has a three handle on it. 3%. 3% is tolerable, right? And so we don't love it. But guess what? You know what treasuries give me? T-bills give me 3.5. That's a little bit above three, right? By the way, the 2-year treasury gives you 425. That's a lot above three, right? And so at least the rates market's giving you positive real yield, even for a little bit more of a shock. So oil goes back to 100. We see kind of headline inflation at 4%. at least bonds still provide you some cushion and some inflationary protection against that. So as you pull it all together, you have to think about the context of investing as well. Is that even though you're concerned about this, the bond market's already re-racked and repriced all of this into its yields today.
So as a trader, you're looking through lots of different subtypes within fixed income, et cetera.
Yeah.
You're managing massive amounts of money. Where do you find, whether there's a hike, not, whatever, just the general scope of the world here today, where do you find value today within the fixed income? What kinds of fixed income are you looking at yourself?
Yeah, no, absolutely. And so here at DoubleLine, we have 85 investment professionals that are sitting outside this room for me today on the trading desk here. These are our portfolio managers, traders, and analysts, right? And when we've been having our asset allocation committee meetings, and the theme has been very, very simple. What can we find that we can analyze that we have high confidence in? And it sounds very simple, right? It's very complex at the end of the day. But the easiest thing to do is find things that aren't related to wars, that don't have this import issue, that don't have supply chain issues. It's also things that are just short duration in nature. They have shorter cash flows. Shorter cash flows, easier to analyze than a 30-year SpaceX bond, right? That's a lot of uncertainty on that cash flow. And again, no disrespect to SpaceX. But the point being is that we're finding a lot of value on that front end of the curve. And so again, from a standpoint, whether we're running a low duration portfolio, which always focuses there, or even in our intermediate funds, we like a lot of the credit risk that sits on the front of the curve. These are floating rate assets in some cases, like CLOs. I know the advisor community has fallen in love with the ETF of CLOs out there. That's something we've traded for almost 3 decades now. So yeah, we love CLOs too. We always have. They got very tight. But they still have some attractiveness out there, and there's significant protection, especially in AAAs today. We like some floating rate mortgages, because the mortgage basis with the vol pickup has gotten a little bit wider. So we like some of the floaters there. But I like a lot of fixed rate credit out there. I like some of the IG market and the IG corporates. I do like some high quality bank loans, like the double Bs. So those again back to floaters. But RMBS, the non-agency mortgage market, a lot of call it 2 to 3 year paper out there today that you pick up in a AAA asset. You're picking up like 135 over that part of the curve. So now you're talking like 5.5 type yields, right? So that starts to get very interesting in today's market.
Hmm.
I have CMBS in that space as well. That's very attractive, and a lot of asset-backed securities. There's been a lot of front-end issuance in like 1 year paper that it's very solid from the consumer aspect. And probably contrary to what you'd think at this part of the cycle, we actually prefer subprime consumer loans, senior tranches of subprime consumers, than we actually do of more junior tranches of prime consumers because the structural protection is much better and just the way the cash flows work. So it's a complex pie I'm talking about there. But what's interesting about it, you pull it all back together, it gives you a low volatility credit solution. And that's what we think is very, very useful in today's market. And if you're risk seeking, look, the high yield markets, you can find some value out there. It's tough to find yields above 7 with something that's not extremely hairy. So we're dialed down in that risk. There's things we like a little bit in that space. But if you're a risk seeker, we really like the emerging market local currency trade. We think that that's something that, it picked up steam last year. We started allocating to it, after the tariff policy came through. So that stuff got beaten up, but it's something that's been one of our kind of favorite sectors to start adding to. Now, we know that it has a lot more volatility than other parts of the market. And so, again, depending on the risk profile, it doesn't belong in your low duration allocation,
Yep.
but it definitely belongs, we believe, as someone's thinking about the next 3 to 5 years, a great place that we think has double-digit opportunity per annum. So all these things put together, and then that's a lot of credit. You've got to have a ballast too. So the ballast to us comes from the rates market. The belly of the curve is the area we like the most. I call the belly like the 3 to 7 year part of the curve.
Hmm.
That seems to be most attractive to us as we deal with fiscal issues. It's going to put pressure on the back end, we believe, but also the agency mortgage market. So now I've identified like 7 different things that are attractive, but any one standalone doesn't look cheap. But when you start putting together and can manage that risk, the portfolio itself looks like it has a lot of value. And that's what I think is important for advisors today as they're looking to their fixed income allocation is this is not a knock it out of the park with fixed income market because spreads are on the tighter side, but
Yep.
it's managing through the cycle type of market. And look, when we've seen some of the kind of cracks out there in some of the high flying stuff, the bond market's worked relatively well. So we think that the setup's really good. You're in a market on low duration, you're getting like 5.25. You go out to the medium duration, with intermediate duration, I've taken a lot of credit risk. You're talking, kind of 5.5 to 5.75. And then the credit sensitive portfolios, you can manage them with or without some duration. But if you do that, you're talking about a low six handle yield today. So it may not be sevens, eights, and nines, that the private credit market will tease in front of you. But at the end of the day, it's liquid and it serves a purpose. And by the way, 6% yields, 50 basis points a month. That really helps people with their income solutions.
For sure. And it's, I mean, you just actually answered part of the question the way I was going to go, but I'll maybe ask you to just elaborate slightly. With the new products that exist in fixed income, there's cheap beta on a lot of things,
Yeah.
right? And I can just buy the ag for blank, right? Depending
Yep.
on who your provider is, et cetera. Clearly, you have solutions all the way down to extremely limited duration up to, wildly flexible.
Yeah.
Talk a little bit about that renaissance in the product availability of fixed income. And as advisors are trying to navigate that right now, you just
Yeah.
gave about 10 great ideas. The question is,
Yeah.
how do you best play them, package them, et cetera?
Yeah, so I mean, here at DoubleLine, we package them together,
Yep.
right? We offer you like an ETF or mutual fund that offers those kind of one-stop shops. But the way we think about it, if beta is cheap and commoditized, well, what is beta? What is the app? It's treasuries, it's corporate bonds, it's IG corporate bonds, and agency mortgages. So if you're buying the cheap beta and you're getting out of that way, not a problem. That's great, but you're missing a huge piece of the fixed income market. There's no leverage loans or bank loans. There's no high yield. There's no emerging markets, what's hard currency, local currency. There's no CMBS. There's no ABS. There's no non-agency. Now notice all the things I just mentioned. Well, what we also do, we offer in the ETF space dedicated exposures there. You want a mortgage solution? We have one of those. You want a commercial mortgage solution? We have one of those. You want an ABS solution? We have one of those. So that's the way we think about those markets. But if you have that cheap beta and you want everything else, we have what some of our folks call the completionist portfolios, right? This is something like our multi-sector income product where it's using all the tools kind of try to manage to an equivalent kind of like let's sell it a double B high yield index. That's kind of how we think about it. We have the toolkit on the other side where it's the one-stop shop for all of your intermediate needs or your low duration needs. So the thing is we try to provide those solutions that can complement that cheap beta. Either you want to outsource the entire suite, of the asset allocation, that would be an intermediate core solution that we deliver. Or if you're going to buy the cheap beta, you're missing some pieces there. Let us help you kind of augment and supplement that portfolio. So that's what we try to develop in our ETF suite is some of these more completionist ideas. So
Yep.
advisors can say, hey, I'm missing this piece of the market. And by the way, maybe I don't feel comfortable enough making that ABS, CMBS, CLO decision myself. Why don't I outsource it to people that have multi-decade experience of doing that and
Yep.
running it on a reward to risk basis?
And I think too, you're trading your own bonds as an advisor. That's the same type of thing. You can't get into every single one and have the staff to be able to look at the underlying credit
Right.
and
And I
opportunities.
mentioned it earlier. We have 85 people sitting
Yeah.
outside this room that grind in these sectors day in, day out. And
Yep.
then we have the people who help put it together, like myself, where together that's that cohesive engine that we think can really add value. And so, look, if you view beta as cheap, commoditized, go for it, but make sure you don't give up this other opportunity to diversify out your fixed income risk.
All right. So I've got time for one more question here, and this one I think it's a fun way to end on
Okay.
this. So, what do you think is the greatest risk of these opportunities? Remaining too heavy in cash, reaching too far for yield, or adding too much duration too quickly?
Ah, they all have an inherent risk in there, cash, obviously, are you outstripping inflation? Maybe, like cash is always an opportunity cost. But also cash makes sense. It manages vol, it gives you an
Yeah.
opportunity. But if you're sitting in cash, you got to think about a way to, how do I step out of that? What will make me step out of that? By the way, we have an ultra short solution that picks up, almost 75, 80 basis points to cash today, right?
Yep.
So for even people who are scared about that, ultra short is a great place to start moving, making that move. Um, Adding too much duration too quick has been really a toxic trade for the last 3 years, right? It's just, or 4 years. We have to go back to 22. And the thing about it is that duration hasn't been behaving like it was for the last 15 years. And if you think about pre-pandemic, the duration, there was no amount of duration enough. Remember Austria, that's 100-year bond. By the way, it got up to like a $200 price. I looked at it yesterday. It's at 29. You're only down 71% if you bought it at par. If you bought it at the 200, we don't want to talk about it. But the world has been rejecting that. And so you have to notice when things change in the market. And this is not a US phenomenon, it's a developed world phenomenon. And so I think the duration risk is scary. It's scary for folks because you got clobbered on it in 22 and it hasn't really helped you meaningfully since. And so there's this reticence there. And I think the reticence is an okay worry to have. But by the end of the day, you need bonds. And so you can still build intermediate portfolios without having to take too much risk out there. And then, you talked about stretching for yield. Whenever you use the word stretching for anything, it's risky. You know it's risky when you say it. But at the end of it, when you're in a tight spread environment, you have to accept it. You can't fight it. And you can't go out and just do things because you think you need to get more. You need to take what the market can give you and what you can analyze. And so I think those are three different risks out there. Which one's the most worrisome? I always worry about the stretch for yield. That's what I worry about because that means you're doing excessive risk taking that's
Yep.
beyond your tolerance. Otherwise, you're just getting yield. If you said you're stretching, that's a different thing. And I point that out because people think that your bond portfolio has to perform strongly all the time. No, you think of it as a total portfolio solution. If your equities are doing well and your bonds are doing okay, you're doing just fine.
Yeah.
My big risk, I would say, Colin, I'll leave this as a cliffhanger to everyone, is that what is the biggest risk you own in your equity book today? I would say almost everyone it would say it's AI risk, right? Tech, AI, software, however you want to call it. You know what you can do in the bond market? You don't have to buy any of that risk. There's ways to get around, take credit risk, take things that are not directly correlated or directly affected by it. Maybe there's knock-ons and other things there, but that's something that we've been talking to a lot of advisors about. And they do just what you did. They shake their head north-south, right? They
Yep.
shake their head north-south and go, yeah, but there's more yield in it. And so it really comes back to that stretching for yield. If you can't analyze that cash flow and you can't tell me with certainty I'm getting paid back, I don't want that risk today. And that's might be my one word of advice to advisors out there. Really think through your books, what kind of risk you own, and make sure you're not doubling down on that, especially in today's environment that's become a little bit stretched.
That's fantastic. And I'll speak for the more than 7,000 people out there and say it's a complex world, especially in fixed income. If you are at all nervous, talk to some professionals like the folks at DoubleLine and make sure you shore things up. So I cannot thank you enough. I know how busy today is and what's on your plate, but
Yeah.
thanks for taking some time to share with us in the community your thoughts.
Yeah, absolutely. And thanks for having me. And good luck, everybody out there with Kevin Warsh's fighting inflation.
That sounds fun. All right, have a
Take
great
care.
day. Be well.
Thank you. Okay, bye bye.
Bye bye.